Hey traders, a very warm welcome to you. So today we're going to talk a little bit about technicals, specifically double bottoms and double top chart patterns. Pretty simple chart patterns, but with all of these things, is my take on it, is how I look at it. If you've got a different way of trading it, then leave a comment below. Tell me whether it works for you, doesn't work for you, what sort of flavor you add to it to make it your own. Because that's the key to trading, is to use it in your personality, in your style, in your trading plan. So we're going to talk a little about double top. And what I like to do first is I kind of like to see what the official line on it is. So in other words, Investopedia, all those kind of big boy websites, what they're talking about, how they define it, and then we'll put a little bit of flavor on why I believe that chart pattern works or it doesn't work. Okay, so double top, they're basically saying it's a reversal pattern. It's a bearish reversal pattern, and as the name implies, it's two consecutive peaks that are roughly equal with a moderate trough in between. Now they're going into some more detail here, but let's put the double top and double bottom patterns on the chart, on the whiteboard, should I say, and then we'll talk about exactly how it's defined in the textbook. Because even though we may not want to use the textbook way of trading it, if we know how others are looking at it and whether they still believe it's a double top or double bottom or whatever pattern we're looking at, we're going to have a little bit more insight into who's on the other side of our trade. And for me, that's the key point. So double top is pretty much as the name suggests. Market pushes up, makes a peak, rolls back over, comes back, retests that peak, and then makes a reversal. And you've got basically this kind of point here where the market hits a level of resistance and can't get through that second time. And it's the same with the double bottom. Market comes lower, tags a low side, tries to push up, comes down, tags a low side, pushes back up again. That's our one in this case, in the bear case, or should I say bull case, depending on whether you're talking about the reversal or the initial trend. But the basic premise of it is pretty simple. Goes to a high, comes back down, pushes up again, can't break through the high, rolls over. Double bottom, same thing, pushes to a low, pushes back up, can't push through the low on the second drive lower. Now, I noticed there's a little bit more accuracy here, and stockcharts.com and Investopedia talk about having how far this should go lower. Now, I've never really considered that as an important factor. Obviously, if you're kind of looking at it and it's going up and it's just holding at highs, that becomes more of a flag pattern. Obviously, a continuation doesn't happen there, but it becomes a little bit of a different pattern to me. So I guess it makes sense that you do have a trough. And here they're pointing out that after the first peak, the decline takes place. It typically ranges from 10 to 20% of this move. That makes sense really, doesn't it? Because ultimately you want to see it come down, not too deep, but still kind of retesting the high within that kind of range. So, you know, it kind of makes sense. The second peak they're saying is that, don't know a bit about volume here, not going to go into volume, decline from peak support break, blah, 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 usual kind of stuff. I think they're overcomplicating it. To be honest, I think that you have to have the first peak, the second peak, rolls back over. This kind of decline, I guess you kind of need it at least 10 to 20% in this area. Too tight, it doesn't really count. Too low, and you've kind of got a different trade because it's gone all the way, it's a bit more of a whipsaw type environment. But what's the logic behind it? Now that's really important for me. I like to think about, you know, why does this pattern work and what it's all about. Now, to me, it's a case of, listen, that's a place where sellers have stepped in and have become interested in the auction process of, hey, this price is now more valuable than it was earlier, and sellers have stepped in, and also buyers have backed off. Now, of course, every buyer, there is a seller, but at some point, the pressure of buying isn't enough to make it tick to a new price, whether that's selling pressure or whether that's buying pressure backed off, it doesn't really matter. But from that point is kind of the level that there's a bit of a consensus of, okay, enough's enough, and then we go down again. Now, at this point here, buyers are still think it's quite good value, so they step in again, they're buying it, pushing back up, but then again at the same point, exactly the same price point here, whatever price level that is, sellers are stepping in and hitting it, or buyers are backing off, whatever that may be. So in other words, this level, this kind of resistance level here, the point 1 and 2, is a level of a line in the sand where price is considered not good value for buyers to buy above, and sellers perceive that anything lower than that, or anything above that, is really good value for them to hit. So you get that kind of stop point in the market. So that's why it makes sense logically to me. Now, how would you trade it? Now, there's two ways of trading it, in my eyes, anyway. And again, you know, if we're looking at the websites, there are going to be different approaches, but I like to do it in this way. You've either got, let's go to the double bottom, look at this example now. You're either going to take it early on. You're either going to predict the double bottom and say, okay, I'm going to put my order here. For whatever reason, I think that that is now a buy there, and I'm going to buy it. Now, it's very aggressive. And of course, you could just be in the middle of a trend and just get taken straight out of that. Or you can kind of have a little level that says, well, if we lift off that by X amount, I'm going to take the trade, I'm going to go in. Or I think you'll find this probably more frequently in strategy textbooks, is to say, listen, there's the peak of the lift back up. You know, you buy it as we cross the peak. Now that's probably going to be more for your swing trading. If you're swing trading it, that's better because you're going to get hopefully a several day week move from that. If you're day trading it, you know, you could find that's a little bit late and you might get stuck in some sort of chop and you might not be able to scalp it out or whatever. So again, with all these kind of things, you've got to twist it and turn it and make it suit you. Take on more risk, but accept you're going to take some losses with that. Take on less risk, etc. It's a kind of odds game. So yeah, you can either take it here, in my eyes, or you can take it as it crosses through the peak. Another way of taking it, which we haven't kind of discussed, is to, if it comes lower, pushes back up, comes lower, and just breaks through the low and comes back up, you can take it on that subsequent break up through the low and then have a stop under that previous level here, using that as your anchor point. That goes through that level there, takes out the low, comes back up, you just stop here, and then you long here. So same kind of thing, double top, double bottom. It's basically a point of where the market can't go any further, key level of support, key level of resistance, a reversal type pattern. Let me know in the comments below what you think about double top, double bottom. If you use it, do you use it in conjunction with something else? Is it effective for you? Do you agree with how I've approached it here, or do you think there's a better way of doing it? Would love to hear from you. If you like the video, give me a thumbs up. If you want to see more videos like this, technical videos, psychology, discipline, strategy, all that kind of thing, subscribe, like. See you in the next one, guys.